Hello and welcome, everyone. Thanks for joining us this afternoon. Kind of an interesting topic here. We're going to talk about deposit growth today. I know this is something that is keeping a lot of people up at night lately. Data, trends, forecasting, what's happening out in the industry. How can we start to think about 2022 because strategic planning is staring us in the face and we have to start making some decisions about what we're going to do next year. So that's why the Finance Council put this session together. We have a fantastic group of volunteers on our Member Resources Committee who come up with things in looking at the member survey results and things that are people talking about in the community to figure out what we're going to talk about. And this was definitely one that had high interest. So my name is Lucinda Athan, and I'm the Director of Communications and Engagement here at the Council. And one of my hats is to help with these sessions. So I'm just going to go over a few logistical things, and then I'm going to hand off to our moderator and our speakers and let them talk to you. So first, I just like to remind people that being a council member, you do have access to a lot of interesting events. Our virtual roundtable program is free to members, and you do have access to content from other councils if it's of interest to you. It's for your personal use. Can't send it everywhere in the credit union, but you can definitely check it out. So the workplace and leadership assessment one, especially, I think will be interesting to people. We're bringing in a career coach to talk about how to use things like Big Five, Strengths Finder, the Enneagram for your own personal growth, but also for team development. So I think that one will be interesting. I'm also doing a community tour next week. If you're not very familiar with that tool, I suggest you join me. And out in the events calendar, you can find all sorts of things that you can sign up for. I'll also note that we are still doing our regulatory and legislative updates every other month. We just did one recently, so the next one will be coming up in October, but that's definitely worth checking out. And each council does their own live chats. And those are also usually topical, but the difference is here we bring in speakers and they talk at you. In the chats, you get to talk to fellow members. That's the whole point. We have a series of questions and everybody dives in, answers those questions, shares their suggestions, their updates, and gets a chance to kind of group think through some things that are addressing the industry and give you some good ideas you can take back and put to work. Also give you one final update that our membership campaign for the summer is still running through the end of the month, so you have a few days left. If there's anyone else on your team that you think could benefit from council membership, $100 off, and we're having a couple of drawings in each council for a free conference and a free 2022 membership. So it's a great time to join if you've got some other people that you think could benefit from what's going on over here in the council. And then for today, just a quick tip on how to interact. So normally in a Zoom room, you'll just have a chat when it's in a meeting. But because this is a webinar session, we also have a Q&A button. That's also down there in your toolbar. And if you have questions for either Andy or Carolyn today, I recommend you put them there, because then when we stop at the end, our moderator, Julie, can go through those, give our speakers a chance to address what it is that you're interested in. So talk to your peers in the chat. We always encourage that, but put those speaker questions in the Q&A pod if you can. And as mentioned, I'm going to get out of the way and hand it over to our moderator. Julie Zink is the CFO at Marshall Community Credit Union across the lake here for me in Michigan. And Julie, why don't you take it away?
Okay. Good afternoon or good morning, maybe. I think it's good afternoon for everyone. Happy to be here for this excellent presentation. I'd like to introduce our two great speakers that we have. We have Caroline Varenkamp. She is the program manager at Research Insights at Radon. And then Andrew Okalski, who is the director of, actually he prefers to be called Andy, not Andrew. He says he only gets Andrew when he gets in trouble. So he is the director of credit union and municipality strategies at the Baker Group. So both excellent presenters for us, and Caroline is going to speak first, so I will turn it over to her.
Carolyn, you're muted. Make sure you unmute yourself, please.
Oh my God, you know, how long has it been since we started this pandemic? And I shared the wrong screen again. You know, this is what happens.
It's not just you.
You just can't get it right. Well, good afternoon, everyone. I'm Caroline Varenkamp. I'm the program manager to Radon Research Insights. I'm a former member of the CFO Council, and so it is wonderful to be able to speak with you virtually again. to talk about deposits and deposit growth and what we see nationally in terms of trends on deposit behavior. We've seen a pretty dramatic shift, obviously, in how we look at deposits and how consumers are looking at deposits. We've seen a significant rise and fall in rates, and then we've had all of the stress of the last year and a half accompanied by tremendous levels of stimulus into the economy, so that people who previously didn't have as many deposits are now doing significantly better with their deposit balances. And we've seen this tremendous push. In addition, we've seen competition from the big banks, from fintechs, and from other areas trying to capitalize on that massive level of deposit growth. And so I'm taking the first half of today's session to really talk less about the forecasting itself and less about the interest rate environment and more about what consumers are thinking when it comes to deposits. So we'll talk about what we've seen from those stimulus dollars, but we'll also talk about rate sensitivity, particularly among young people, the transfer of wealth to young depositors, and the threats to our industry that the big banks and the fintechs represent. So first off, you felt it, but sometimes it's really helpful to see in a chart how significant the flood of cash into the banking and credit union industry really is. So this is just FDIC insured institutions, but we've seen a very similar chart for NCUA insured institutions. Look at those last 5 bars and how massive, this is a quarterly change, how massive the increase of cash into the system has been. We've seen nothing like it ever. Look back over to 2008, 2009, 2010. Like we thought that increase in the middle of third quarter of 2008 was significant. Like that's a drop in the bucket compared to what we have now. We consider that a significant flight to safety during the Great Recession. The growth we've seen now is 7 times larger on a quarterly basis. There's been nothing like it. And it's had a huge impact because most of us obviously didn't plan for this, but consumers didn't plan for it either. And it's having an impact on how they're viewing things as well. Right now, rate tracking is at extreme levels. We ask consumers, we do a survey every year of consumers nationwide, all ages, all demographic groups, to get a handle on how they feel about savings and how they feel about their banking when it comes to deposits. 27% of consumers say they actively track rates. They're actively paying attention to the rate that their savings are earning. And that was only 9% in 2018. So the rise and then fall in rates combined with the amount of deposits into the system has made rate tracking at a phenomenal pace. There's another 31% that watch rates but don't really pay attention. They don't really find one that's worth switching or moving money to get a better rate. And there's about 42% that don't really pay attention to rate at all. There's 2 groups that rate track the most. One of them are high depositors, people who have at least $25,000 in deposits. And then that makes sense, right? These are people with significant savings. They're more likely to pay attention than people who don't really have any savings at all. But the other group, and perhaps the more surprising group, are millennials. You can see there the percentage of millennials, is 46%, who are actively tracking and paying attention to rates. And to see really how obscene or see how extreme that is, look at how they compare to other generations. Only 10% of baby boomers are actively tracking rates. Only 4% of what we call traditionalists, we might call the silent generation, are actively tracking rates. Millennials are off the charts. And we don't often think about that as credit union finance executives, because we often think about those rate shoppers being the little old ladies who have the newspaper clippings who come into our branches and say that community bank down the street is offering X% and we need to match it on their 3-year CD. That's not this. You're not seeing these millennials in your branch asking about the rates from the newspaper, but they're paying massive levels of attention. And largely because to them, like the rates that we're seeing now and a fractional change really makes a difference. Whereas baby boomers remember back when they could earn 12% on a certificate. So seeing a 1% here or 0.5% there means practically nothing to them and they don't really care. But to millennials, it makes a difference. They've never had a high rate environment. And we teased them just enough in 2019 to get the pump primed. So now they're really paying attention. To measure rate sensitivity, one of the tools that we use nationally is by asking consumers, right? So we ask over 1,000 consumers and we say, hey, how much would it take to move your money to a new account at your own institution or to move an account to a new institution? And we kind of add those up as they go, right? So they get a variety of selections and they can choose, okay, yeah, I might move to a new account at my current institution for 0.25%, but it's going to take a 1% increase to get me to go to a new institution. So we can add that up. And so what we find, that purple line represents the cumulative rate required to move to a new account at their own institution, right? A new savings account's opened. Okay, I'll go jump to that. I'll go through the hassle of doing that. And the dark gray line represents moving to a brand new institution completely. And as you can see, it's about that 1% mark where you really get some movement in terms of people being willing to jump. And once you get to about 1.75% jump, that's where you get the majority of consumers being willing to move. Now, back in 2018, so it's a 2019, to get a majority of people to move to a new institution, you needed to offer a 3% higher rate. So this is an incredible shift in terms of the percentage of consumers willing to move for a relatively low rate increase. Look at how this has changed. This is just a change just from 2019 to 2020, and we've got the 2021 study in the field now. That purple line is where we were like before the pandemic, and the dark gray line is where we were at the end of 2020. And you can see that shift up in terms of percentage of consumers willing to move for a relatively lower rate to a new institution. So in this case, it's 3% to get half. I don't know a way to do fancy drawing on this, but there's an annotate button, fancy. Every single presenting tool is different, so it's fun to mess around with this. So a year ago, oops, it was 52, and today to get a 3% increase to get a majority, today it's a 1.75% increase to get a majority of people willing to move to a new institution. Here's why rate tracking matters and why we care if someone is paying attention to rate, because that's the best predictor for sensitivity. So here, to get half of those who aren't paying attention, like they're not going to move for barely, and you have to go way above a 3% increase to get them to be willing to move to a new institution. Those who watch occasionally, you've got to be able to beat them by 1%. But those who watch, who are actively paying attention, if you can get them between 50 and 75 basis points, you're likely to get there to move to a new institution. They're certainly willing to consider it. Now, obviously, this isn't a vacuum, right? This doesn't include things like the brand or convenience or other factors that might influence somebody's willingness to move deposits, but it certainly shows how sensitive we have become as a consumer society. And what this leads to, because they generally aren't getting those kinds of rates at their traditional depository institutions, is an increase in internet savings accounts. So for the longest time, throughout the course of the 2010s, we had a very consistent 14% or so of consumers actively having a savings account, right? About 14% consistently. But now that number has jumped up to 32%, being consistently currently using an internet-based savings account. Whereas the percentage of people who would consider it has just continued to rise in addition, right? So now 1/3 of Americans say they have an internet-based savings account, and we really describe what that is. So it's not just that they have a regular savings account that they access online, but really describe it as being one that you don't have a branch access to. 30% they do. And those who say they have an online savings account, 41% say they opened it in the past year, which tracks pretty well to the percentage increase from that 22% to that 32%. So a significant impact from our industry in terms of deposit dollars being willing to move to internet savings. And as you can imagine, the group that uses internet savings the most are millennials. It matters for us because we don't have their business. We are so reliant on the older generations for our deposit dollars. For the typical credit union that we work with at Radden, 23% of our deposits come from that silent generation, people who are pre-baby boomers, who at this point are 76 and older. And almost half, 47%, come from baby boomers. So we are far too reliant on older Americans to provide our deposit funding, those older members. Only 12% of our deposits come from millennials, who are at this point are generally our largest group of members at a given institution. But here's the thing, within the next 25 years, we expect $68 trillion in deposits and investments to move between generations. $68 trillion nationally are going to move, and they're going to move to the millennials and to an extent Gen Z. So your ability to have those relationships with those members is going to be critical to your ability to retain those dollars as the wealth transfer happens. So what's happening with those dollars? Well, investment usage is back to levels before the Great Recession. So after the Great Recession, a lot of people lost their shirts and we saw investment usage decline throughout the course of the 2010s. That has reversed itself, primarily because of millennials. 50% of millennials now say they have non-retirement investments and have added to them, which makes them one of the more actually above average in terms of investment product usage. So they're not the people you're talking to in your wealth management departments either. Why is this a threat and why does this matter? Because the deposit growth we've seen is not evenly distributed, right? That massive increase I was showing you in the FDIC charts, those haven't been equally applied. So on the left is the FDIC and on the right is our credit unions. And we show how much they've grown in deposits over the course of 2020. And the slide says first half of 2020. This is all of 2020. So over the course of 2020, the 10 largest institutions, banking institutions, became the 13 largest because a couple of them actually increased in size, and they added $2.5 trillion of deposits. Whereas the next 130 only added less than 500 billion, right? So you can do the math. You guys are finance guys, and you know how to do math. You'll see that the average deposit on a deposit growth per asset really favors the larger institutions, both in banking as well as in credit unions. Smaller banks and smaller credit unions have seen deposit shrinkage in this period on average, even when accounting for collapsing institutions and consolidating institutions. And that's putting pressure on the industry because the dollars are going to the big players. Those big players are now the dominant force of banking in our country. What this shows is the percentage of consumers saying that a particular institution is their primary financial institution. So for, again, the course of the 2010s, about 40% of Americans said that their PFI was one of the 6 largest banks. And about 20% of Americans said that their PFI was a credit union. Those numbers had been ridiculously consistent over the course of the 2010s. And in fact, they're very similar to what they were throughout the course of the 2000s and the 90s as well. But look at what's happened in the last 2 years. Now, 59% of Americans say that their PFI is one of the 6 largest banks. And only 12% of Americans say that their PFI is a credit union. Now you may ask, how do we define PFIs? Well, we just ask them. We say, what do you consider your main, click the box, which of these best represents your main or primary source of financial services? And it can mean anything, honestly. And our research seems to indicate that the days when it meant that's where I have my main checking account are gone. Any number of things can connect somebody to being primary, even brand resonance. So the major banks are capitalizing on that. And one major bank in particular is, and that's Bank of America, who is responsible for the majority of the growth in this number over the last 2 years. And look where that growth is coming from. So the green are banks and the purple are us. Just 2 years ago, 20% of millennials, just right in line with all the other generations, said that their PFI was a credit union. And then we had a pandemic, among other things. And now it's only 8% of millennials say that their PFI is a credit union. The major banks have gone from 47% to 73%. And Gen X, old forgotten Gen X, almost as bad in terms of movement to the big banks, while the older generations have generally stayed pretty consistent. They're generally happier with where they are. Now, this looks bad for credit unions. It looks worse for community banks. Community banks have almost zero millennial penetration, which makes you wonder what's going to happen again when those millennials who aren't using those institutions get all that wealth transfer over the next few years. Why are they going to the major banks? Mobile banking plays a huge role, right? Of those who say that a major bank is their PFI, we ask what factors are extremely important to you in selecting a major bank. And it's online banking, it's fast and efficient service, it's mobile banking, it's proper solutions to customers' problems, and it's even bill pay. These are the things that really matter to them, more so than even member service or customer service. Only 38% of credit union primary members say that mobile is extremely important to them. So we're looking at a very different group and very different reasons for doing business at these institutions. Here's the other problem we face as credit unions. We did worse in reaching out to our members over the course of the pandemic than the banks did. And look at the impact that that's had. So among those people who said that their PFI reached out to them over the course of the pandemic, and by reaching out, I mean phone calls, emails, texts, smoke signals, I don't care. Look at how the major banks did. Those major bank primary customers whose major bank, Wells, Chase, B of A, PNC, US Bank, and Truist, SunTrust / BB&T, a quarter said that their opinion improved, and only 3% saw a decline. But look among our members, those credit union members whose credit unions reached out to them during the pandemic, only 7% had a better opinion. Why do I mention this? I mention this because we're thinking about deposit forecasting. We're thinking about how deposits are going to grow. We have to understand that the consumers who are going to be bringing new deposits, who are going to be getting the deposits and inheriting the savings and building the savings, aren't coming to us anymore. And they're going to the major banks for mobile and for customer service, of all things. More importantly, and our sake as well, they're just not going to deposits at all. One of the big misconceptions is that millennials have no money. They say they have no money. They've got money. They also have debt. The student loan issue is an issue, but they do in fact have money and savings. They're just not keeping them in institutions as much as going to a place like this, Robinhood. So micro investing, you can trade as little as $1. There's no commission, very low dollar investments needed to break in. 8% of millennials, we did this study, I think we did it in late 2019 actually. 8% of millennials said that they use this kind of program, and another 40% were extremely or very interested in using something like this. And they have reported phenomenal growth over the last year, as we saw in a lot of the news that came out about GameStop and that sort of thing. These apps get almost no play among baby boomers and the silent generation, the traditionalists. They are not recognized at all. They don't need to. They can go to a wealth management seminar or go see their wealth management person at their credit union or their bank and have a personal service. Millennials don't have that opportunity. They don't have the dollars all at once. And often they aren't even allowed. A friend of mine at Radden got a letter in the mail inviting them to a wealth management meet and greet at a steakhouse and attend the seminar and get a free dinner. And literally on the sheet, it said no one under 40 permitted, which was pretty exciting to see for those under 40, because they're the ones that are going to be great bringing the balances as we go forward. And yet this particular wealth management firm was more than happy to let them go. All of this boils down to kind of 4 key areas for you to think about, and that we can build off of as Andy talks about the nuts and bolts of interest rate movement and forecasting into 2021 and beyond. Stimulus dollars have flooded in, but that growth has not been distributed evenly. We are overly reliant on older members for deposits, and we risk losing those dollars as that wealth transfer to the younger generations that we don't have. Millennials are far more rate sensitive. They are far more supportive of the big banks, and they are far more willing to invest in fintech apps, all of which represent threats to our ability to retain those dollars. And ultimately, and I firmly believe this from my days as a CFO in Oregon, deposit management is as much demographic as it is financial. It's understanding the potential and the opportunity within your membership base, as it is understanding the rates, the flows and the stocks of your deposit business. So with that, I'll turn it back over to Julie for any questions that you might have.
Okay, I have to get myself in gear here. I completely tuned out while Caroline was talking. I have no idea what she said. No, just kidding. All right, we do have a couple of questions come in. Before I get to those, though, somebody did comment, and I thought of this too, Caroline, when you were talking about the wealth transfer, you talked about to Gen Y and the millennials and Gen Z, and you completely overlooked us Gen Xers. So,
well, yeah,
we are going to get some wealth, I believe.
We'll get some, but there are so few of us. I mean, ultimately speaking, it's kind of terrifying how relatively few there are. We're special snowflakes.
Okay. Okay, so the first question that came in was, do we know how these generational differences compare to generational differences from, say, the early 2000s, when Gen X was the group in their prime earning years?
In terms of what? Because there's kind of a lot going on, right? In terms of like popularity with credit unions, like the 30-year-olds today are far less connected with credit unions than the 30-year-olds were 20 years ago.
Okay. Yeah, I mean, I think that is a good question that, is it just as these generations get older, they're going to go through the same evolution? No. You're saying no. Okay.
No, they won't. Now, I mean, I will say, we did a whole study just of millennials, and we found that about 40% of millennials, and higher actually among those who say a big bank was their PFI, are willing to leave. I mean, they're considering, they're able to go. So they aren't firmly tied and locked in and loyal to those big banks to the degree that they could be. So there is an opportunity to win them back. But we are at a worse position than we were with previous generations a couple decades ago.
Okay. Second question, are dollars flowing to the big banks because of higher rates, or
No.
is this more of a correlation?
It's a correlation. It's not rate driven. It's relationship driven. And consumers are finding value in being at the big banks, and so they're bringing their dollars with them. But again, for a lot of millennials particularly, their primary deposit accounts are not at a traditional bank or credit union. They have deposits in internet savings accounts, and they have investments at fintech apps as well. So it's more beyond just the scope of like, oh, I've got a checking account at Bank of America and I have a savings account there too. They've got their checking account at B of A, but they have their dollars elsewhere.
Okay.
And they move quickly. If there's no barrier to entry anymore, you don't have to go into a branch and sign a bunch of papers anymore. It's so easy to open up a savings account now online, and they have no problem doing it. They have no problem with going on their phone, finding a good rate, hitting apply, and moving their money.
Okay. Well, let's see. It looks like we might have one more question here. Oh, okay, the question is, I know this presentation is on deposits, but any data on loans? So I guess, Caroline, do you have anything to say about loans at this point?
Oh, there's lots of loans, but I didn't prepare it. No, I mean, lending is of course different than deposits because, you know, whereas we've always historically said that people like to be near their money, they like to be away from their debts. Lending, generally speaking, we don't see the same degree of movement towards the largest financial institutions. And that is largely because the technology isn't as important for lending. It is important, but it's not as important. There's still so many people that get loans at point of sale, like an indirect auto loan, for example. And there are just so many other players, mortgage companies, you know, fintechs that specialize in mortgages, credit cards, but we're going to have a lot more on lending coming out. So maybe we can talk about that another time.
Okay. I think this wraps up. Let's see, maybe another question coming in. I am interested to hear more about how there's little barrier to entry, but at the same time, they are not rate driven. Are they finding more relationship advantages online? So this is back to deposits.
Yeah, I mean, so again, they are rate driven, right? But that's the point, right? They're rate driven so they can say, oh, wow, I can get a 1% savings account at Ally. I'll just open that there. Or, oh, wow, they're giving me a discount, you know, give me extra, you know, $20 a month to move my checking savings account to X institution. I'll do that. And so they're looking at those and they're finding those opportunities and moving their dollars like that and opening accounts other places. And there's no barrier to entry to that. They keep their main relationship or they consider their primary financial institution. That decision is not rate driven. That decision is based on convenience, both digital and personal, and a customer service primarily. Does that make sense?
Yes, I mean, to me anyway.
So.
Okay, so I think we'll probably have to move on. Lucinda, should we move on to Andy, or should I keep taking questions for Caroline?
I recommend we move on to Andy, but Carolyn, if you don't mind, if there are some questions that come up, if you want to answer those in the chat or in the Q&A pod, that's a great way to interact with people, but that way we can hand it over to Andy. And
so I'll answer the last question of what touch on some of this actually, but there are a variety of things to do that don't speak necessarily to rates from a marketing type of perspective, where you could focus on the reasons that people are saving as opposed to the price at which they're saving, right? The same way you would offer loan products or credit cards or other things where you might not be focusing on the rate, but more about the solution that you're offering. And that could be a way to compete by focusing on the goal. One of the big key issues with millennials and one of the opportunities that we don't really talk about is term deposits. No millennial knows what a share certificate is. I mean, most Gen X's don't know what a share certificate is. And a certificate is something you get for finishing 4th place at field day. It's not a savings instrument. But if you explain it and sell it as a savings account where you lock in your money for a couple of years and you get a better rate, you get a lot more business. And so those are the kind of things that you can take advantage of. You have the products and you have the services available, and you don't necessarily have to offer giant rates if you just align your product set and the descriptions of those sets into a language that younger people can understand.
Okay. Thank you very much, Caroline.
You're welcome.
Lots of great information. Next we have Andy, and he's going to, we're going to hear his take on things.
Okay, thank you, Julie. And Caroline, I don't think this could have worked out any better considering we both did our presentations separately, I swear, right? So I agree with everything that was said, and I think it was focusing a lot on kind of the medium to long term impacts, right? So or risk, I should say. So what I'm going to do is focus a little bit more on some of the immediate issues that I see possibly coming up. Okay, so to kind of get us started here, right? When we take a look at some of the conversation, especially the last few points, where it's about convenience, it's about service, it's about rate, depending on what we're talking about, but I think it's more convenience and service. That costs money, right? You want to have better tellers and better member specialists that offer better services and all these things. There's a cost to that, right? So how do we cover that cost? We have to increase our margins. We have to increase our earnings, right? So when we talk about this whole liquidity situation that we find ourselves in of historical levels, I think we need to start with earnings real quick. Okay, so if we look on this page here, you have the 10-year treasury and the 3-month treasury going all the way back to March of 2007, right? And of course, from March of 2007 to current, we've had two pretty strong adverse situations with the Great Recession and now the pandemic. And what I think is interesting is when we go ahead and we throw the margin on this graph for the entire industry, there's certainly some correlation to the industry's margin and the amount of spread or direction of interest rates. Of course, that's why we measure interest rate risk as often as we do. But it's not perfect, right? If you kind of take a look a little deeper, during the beginning of the Great Recession, the actual recession portion of it there, even though interest rates were dropping, the 3-year and 10-year both falling through the floor, actually the margin for the industry increased during that time frame, okay? We didn't really see the compression portion of that until much later in 2010. And by then, interest rates had actually stabilized near zero, to be fair, but they've stabilized a little bit. While things tightened, right, the overall curve tightened here towards, coming out of the Great Recession. And again, you see a tightening curve, you see a flattening curve, you think, we're definitely going to be talking about margins having a lot of pressure. And once again, the margin increased. Until recently, we had our issue with COVID, and you can see pretty clearly what happened to margins because of that. So I think the first thing we have to do here is take a step back and say, okay, if I want to compete better to keep these deposits and eventually hunt millennials, good luck. They're not the easiest to get your hands around. It's going to cost earnings, and I have to manage my liquidity properly, right? I look here and say it's more than rates. All right, so let's take a deeper dive. Let's look at liquidity as a percentage of average assets. And again, this is the entire industry, right? We all know in the first quarter of this year, we hit a record 14.7% of total assets were cash and cash equivalents. I don't have to tell anyone on the phone here that was not and continues to not be sustainable from an earnings standpoint. But if we go back to March of 2007, we can also look at the average level. Right. So on average, since March of 2007, the industry has had 7.5% of their total assets made up of cash and cash equivalents. Okay. If we dig even a little deeper and we say, okay, well, now we know what the average was, right? The average was 7.5%. Well, let's highlight just those periods of time, just those quarters where the amount of liquidity in the system was higher than the average. And you can see there's some noise in here, right? But if you look, almost every one of these is a Q1. Well, what happens in Q1? We have tax returns. We have all the deposits flow in the door. I've been working with credit unions for approaching 20 years. Q1 has always been, at least pre-COVID, the biggest deposit growth quarter, no matter what. So we can ignore that a little bit, but clearly you see this huge chunk of sustained liquidity after the Great Recession. And then we see the record chunk of excess liquidity more recently. And what's interesting is if we go ahead and we throw the margin chart back on the page, almost to the day, margin compression lines up with extended amounts of excess liquidity, right? So here's a little bit of kind of a stepping back thing here. Most of the fears, and some of this I think is from kind of the NCUA examination standpoint, but whenever you discuss liquidity, the two biggest things are, I'm terrified what happens if we don't have enough liquidity, right? And when should I worry about these deposits leaving? Those are the top two conversations. But then we look at this chart, and I would sit here and say, just at a high level, looking historically, not having enough liquidity is not the problem, right? When liquidity is more stressed, we tend to be doing better in terms of earnings and margins. When we have way more liquidity sitting around than we know what to do with, that's when you need to look out, right? That's when our margins have the most compression. And that's where we, in essence, lose the largest amount of income and spread. So look at that a slightly different way, maybe a little bit more detailed here. This is once again cash and cash equivalents as a percentage of assets. In this case, went all the way back to 2002. And there's our starting point, right? So Caroline made the comment that we all thought the surge in deposits after the Great Recession was a big deal. And we see I won't say it's nothing, but it pales in comparison to what we've had recently. But if we look over here and say, okay, we hit 12% at the end of 2020, right? We were up to almost 15% by the time we got to Q1 of this year. And now we've recovered a little bit, but recovery may be a strong word considering we're still pushing almost 13% of the industry's assets in cash, which you guys know on a good day is earning what, 7 to 10 basis points. We also can look back here and say, we already looked at it and said the average is 7.5% more or less, going back to 2007. But when I look back and kind of lay these charts over just, been doing this long enough to remember the times when clients were really tight on liquidity versus really heavy on liquidity, it seems to be the closer we get to 7% of cash, of assets in cash, that tends to be when liquidity is a little bit excess, right? A little bit more investing, a little bit more cash sitting around. And on the other side of the equation, when the overall cash position of the industry starts getting down towards 5%, that's really super tight liquidity. 2008 is a perfect example. We got down to almost 5%, and that was a year, for many reasons, where liquidity was a real concern before the deposit growth came rushing in. So when we're looking at these things overall, right, it shows us the magnitude of what's happened recently compared to where we, quote unquote, normally tend to run. And again, as I said before, the big question we get all the time is when will this liquidity leave? And unfortunately, I'm going to tell you, I'm in the camp that I won't say never, but I'm certainly going to say no time soon, right? You have my promise. This is the only COVID-related slide in the entire deck. We will not talk of it after this. But the elephant in the room, I've had a few people say, well, now that COVID's over, what do you expect as far as deposit and loan demand goes for the rest of this year into 2022? And I've had to unfortunately break their hearts a little bit and say, nobody wants it over more than me, trust me. But when you look at all the signs, COVID's certainly not going away, or at least it's not gone, right? It's still in the news every day. Whether it's good news, bad news, or arguing, it's on the news every day. Now there's breakthrough cases. So supposedly, even if you got the vaccine, you're not totally safe. And now there's talk of booster shots, all stuff you don't want to hear about on this call. But this is, our members every day are seeing this on the TV, right? They get home, turn on the TV, and this is all they're talking about, right? So I think the first thing we need to realize is just from a variables we can't control standpoint, COVID's not over. It's not gone. Hopefully we can laugh about it next year. But as of right now, I don't see a situation where we can count that out. But then we can look back and just say, let's just look at shares in general. Forget COVID, forget everything else, right? This share growth that we talked about, right, in 2009, the industry got up to over 10%, which clearly, with the exception of more recently, was record amounts of growth. And for those of you that were balancing or managing balance sheets at the time, you remember the big conversation was, are these surge deposits, right? Everyone's examiner was very concerned. These are surge deposits. As soon as interest rates go up or as soon as anything changes, they're going to run out the door. So keep them short, keep them in cash because they're not going to be here too long. Well, if we look at the growth rate for shares, and I will concede that this is the full industry data. So that, a big enough sample size, the data goes a little bit in my favor. But if we highlight 0%, in order for those supposed surge deposits from 2009 to have walked out the door, left the industry, that orange line at some point would have had to cross through zero year over year. And you can see it never did, right? In 2013, the pace of deposits coming in certainly slowed down and we hit a bottom of 365, but that was still deposit growth overall, net, right? When we come over here and look at what happened more recently, again, now we're talking about 15 to 20% deposit growth. So of course, historical amounts of deposit growth. But, again, we have the same conversation, right? You have a lot of folks running around saying, well, clearly these are surge deposits and they're going to walk out the door any day, right? Keep them close because they're going to be walking out before you know it, as soon as things go back to normal, as soon as things open. Well, not that the Delta variant's helping, but most of the country's open. I'm in New York, so I can tell you compared to last year, we're open. We're very open compared to being locked in the house. So most people are somewhat kind of getting on back to normal here. If that was going to be the event that was going to trigger all these deposits to run out the door, I'm kind of in the camp we would have seen it start at least by now, right? So my opinion is, let's take a more analytical approach this time. Okay, I saw a lot of credit unions lose a lot of income during the Great Recession because they believed the surge deposit fears and they stayed really super short. And as rates just were grinding along the bottom near zero, they were sometimes not even earning as much as Fed funds on certain investments, right? So I think this time we need to take a little bit more of an analytical approach, right? So let's take a little bit of a deeper dive here. When we're trying to measure liquidity, you're trying to do a somewhat, let's call it reasonable / accurate liquidity forecast. In this case, we're talking 12 months, right? So this is the calculator that we built for our clients. You really only have a couple of levers, right? Why make it complicated? You have loan originations, you have loan pay downs, you have investments, which we'll talk about in a second, and you have deposit inflow or runoff. That's really all there is, right? So when we take a look back, rather than make the mistake that a lot of people make, usually this time of year, I start talking about budgets and I'll say, well, hey, what are we thinking for next year? 20% loan growth. Okay. Going back 20 years, the best loan growth you've ever had was 5%. So what do you think for next year? And with a straight face, I'm told 20% next year is going to be different, right? So I'd like to look at historical data and try to make a more reasonable analysis that we can actually use to improve performance, right? Instead of wishing, right? Hoping that we get, record-breaking loan growth. So for the industry, go back to March of 2007, the fastest rate of loan originations was 6.27. Unfortunately, you can see it was very short-lived there, right in 2011, 2010. But the loan originations in that month were 6.27% of total loans. Borderline impressive. But you have that one standout and everything else significantly lower than that. So then we came back and took the same analysis and said, well, let's look at the average, right? Because we can't just assume that this one, I won't call it a fluke, but this one solitary event of great crazy loan growth is going to continue going forward. So let's use the average, which is 3.92%, call it 4, make math simple. So our loans, we're going to originate 4% of our total loan portfolio. Remember, this is monthly, right? Not annually. We then have to include loan pay downs, which this is the part where so many liquidity analytics go wrong, right? We're not just putting new loans out the door. Unfortunately, some of the loans we love are paying back to us. That's why, your loan officers will have a $20 million month, but your net balance only goes up by $1 million, right? Because we're fighting the tide coming in at the same time. So if we do the same analysis, the max level of loan pay downs, funny, in that same exact time, 2011, 6.47%. My opinion or my assumption there would be that was obviously because of the refi boom that was incredible during that 2010, 2011 with HARP programs. And basically, if you had a pulse, you could refi. The average, so, ignore the highest, ignore the lowest. Let's just look at normal kind of behavior going all the way back to March 2007. We can see it's about 3.5%, right? So now we turn around and we start saying, okay, well, if I'm going to assume 4% roughly loan originations each month, 3.5 loan pay down, okay, well, I'm starting to stress my liquidity, right? Because I'm going to have to, my net loan growth is going to be about 0.5% every month for 12 months. On the investment side, we had to get a little bit cuter because we're working with core report data here, which doesn't give us the amount of detail we would like. So here, remember, it's a 12-month liquidity forecast, right? So what we did here is we said everything in the less than 1 year bucket, well, it's safe to assume that all that comes back to us in the next 12 months. So we take that number, we take the 102 billion, we divide it by 12, there's our monthly roll off there. But then some of the investments in the 1 to 3 year bucket, the 3 to 5 year bucket, even the 5 to 10 year bucket are amortizing, they're callable. So some of that money will likely come back over the next 12 months, but a smaller percentage. And we wanted to be conservative. So we assumed that 30% of the investment dollars in 1 to 3 years would come back over the next year, 20% of 3 to 5, 10% of 5 to 10, and nothing over 10 years. We figured that was kind of a pretty safe, conservative assumption set there. So now we get to deposit runoff, and here's where the fun starts. So as I mentioned before, year over year, the industry has never seen deposits go down. So if we're trying to do an analysis of how fast do deposits leave, well, it's kind of hard because the answer is they never do, right? at the industry level, they never do. It's the line kind of does this, right? So we had to then go back into quarterly data to find a few quarters where there were deposit outflow overall for the industry. And the most important one I want to point out here is actually the max. So the fastest deposit outflow, the few quarters that you can see are the gray bars, the few quarters where the industry saw net deposit amounts drop, the fastest one by far was the one right in 2008. Again, makes sense, right? That was the financial crisis and everything was kind of upended. And it was just short of 0.5% for the month, right? So we're trying to measure liquidity. We're trying to be realistic, but also conservative. And so we start to put together some assumptions here. And although quote unquote surge deposits have been proven in the past to not be as rate sensitive or time sensitive as expected, we're going to go ahead and assume that we get that same worst case runoff, right? So now we can do some math, and these slides will be sent to you afterwards, so don't worry about squinting to see some of the numbers. Taking the entire industry as of the end of the second quarter, right? What if we assume that loan originations going forward are at the average pace since 2007, the 3.9%. At the same time, loan paydowns going forward are at 3.5%. Again, that's the average going back to 2007. Investment cash flows broken down as we said before, right? So everything from the less than 1 year bucket and then small bits from the other buckets, totaling 165 billion worth of investment cash flows coming back over the next 12 months. And then here's the real stressor, right? We're going to go ahead and assume that starting starting July 1st in this case, deposits are going to start walking out the door. Okay, it's never happened for a prolonged period for the industry, but for the fun of it, let's assume it does. In fact, let's assume it happens at the fastest measurable pace since 2007, which is that 0.42% per month, right? So here, when we start narrowing everything down, right, we're starting with $248 billion in cash as an industry, right? Roughly almost 13% of our assets. With these assumptions in place, right, look at our ending point, right? 12 months from now, we actually increase in cash to 272 billion, and we head back to almost 15% of total assets. Okay, so think about this for a second. Loan origination is average, not stellar, not horrible, right at average. Same with pay downs. We don't buy any new investments, okay, but our investments keep maturing. And then we assume that almost 0.5% every month deposits walk out the door. You can see there it's $7.3 billion a month, roughly, leaving the industry. And we still end up in a situation 12 months from now where we actually have more cash than we did as of June 30th. Okay, so why do we go down this road? Why do I talk about this? It's because we should be talking about deposits and loans. We should be talking about liquidity, but I think a big part of the equation needs to be not only focused on, well, what happens if this money leaves? We have to talk about, well, what if it doesn't? or not as quickly as we thought it might, right? Because all of a sudden you start looking at some of these numbers, right? You take 248 billion, and let's just say we have an alternative asset yield. Investment loan doesn't matter to me. At a 115 yield for 48 months. If instead we leave that money in overnights at 10 basis points because we think, we're scared, right? These deposits might leave any day. Loan demand might spike any day. Well, in the beginning, 3 months, 6 months, it's livable, right? The foregone income is nothing that you would really lose too much sleep over. But if we start forecasting out more to where the Fed is talking about interest rates potentially rising, 2 years from now, 25 months out, give or take, all of a sudden the foregone income in this example here is up to 5.4 billion of lost out income, okay? If at that point, 25 months from now, you sat there and said, wow, you know what? It is what it is. We lost out on all this money. I need to make it up, right? I want to make up for this foregone income that I missed out on. You would have to find a 2-year investment yielding almost 230. Now, I'm not saying rates won't go up. The Fed is certainly out there thinking they're going to start ticking up here again, potentially in 2 years, if you believe them for that at this point. But they're talking about an increase or two, which is 25 to 50 basis points. You guys know as well as I do where 2-year assets are yielding today. If we see an increase of 50 basis points, it doesn't equal 230. Okay, so measuring or more importantly, managing your liquidity correctly over the next 12 to 18 months, I really think there's nothing more important, especially with the industry's net worth ratios being pushed and stressed as hard as they have been, because no one expected 20% share growth over a 12-month period, right? So we need to be looking at both sides of the equation here of want to make sure we have enough liquidity, but we also need to make sure we don't miss out on too much income because we're waiting for this liquidity event that historically at least shows that it doesn't likely come, okay? Last slide here for you. This is the part of the equation that I don't think enough people talk about. So we can talk about deposit inflow, outflow, we can talk about loan growth, we can talk about all these things, and they're all infinitely important. It's why we build that analysis, right? We should have that conversation. But don't forget that the deposit conversation and the liquidity conversation are related, but very different, okay? Because your liquidity is not just the money you have sitting in overnights, okay? Your liquidity includes all of your contingent liquidity sources. So when we look at this for the entire industry, yes, that includes cash. Of course it does, record amounts of cash. But it also includes securities that we can sell if we had to. It also includes all of your lines of credit. It also includes all of your non-member deposits, which the NCUA last year increased the limit to 50% of member shares, right? So if you use round numbers, a $2 trillion industry has roughly $1 trillion worth of contingent liquidity at their disposal, right? 53% of total assets, even after we factor in contingent liabilities, right? So sure, credit cards, home equity loans, all those lines of credit, they're usually the biggest piece. Even after we factor that in and we take a look, your net contingent liquidity, right? So contingent liquidity minus all those contingent liabilities has never been higher in the industry than it is today, okay? So when you're having these conversations and when you're doing these forecasts to try to predict your liquidity needs, balance versus your earnings and margin needs, remember that there are so many additional liquidity sources and make sure they're part of your analysis, right? Last thought I will leave you with here. Not only has accessing wholesale funds, right, become a huge, bigger piece of the puzzle than ever for the credit union space, the way that it's accessed has changed dramatically, right? We have blue bars here are borrowings, the orange are non-member deposits, and the gray bars there are loan participation sold, and the total wholesale funds is the red dotted line behind it. So certainly I understand the dip in wholesale funds recently with the deposit growth, but overall the trend of accessing wholesale funds has increased over the past 11 years. But look at it, 2010, 74% of the wholesale funds came in the form of borrowings, only 6% in non-member deposits, almost 20% in loan participation sold, look at that recently, right? Borrowings from 74 all the way down to 47. Non-member deposits from 6% to 12, double. Loan participation sold from 20 to 40, doubled, right? There are other avenues. There are other options, right? Worst case scenario, everything in moderation, but worst case scenario, if you put your money to work in anything and you get the additional earnings, you get the additional margin that you need now, and 6 months from now, you find yourself in a situation, we can borrow, we could do non-member deposits. We can sell loan participations, which, by the way, doesn't even negatively impact your net worth ratio. So conversation for another call. So the level of liquidity is more than just your cash. And I think these are some of the things that we need to kind of be taking into account when we're doing this analysis. I'll leave you with the simple thought that Caroline talked about a lot of very real risks over the next 5+ years. I don't know of a bigger risk in the next 12 to 18 months than what we talked about here today. Sitting in way too much cash, giving up that margin in net worth, and not being able to recoup it when the Fed doesn't deliver and rates don't go as high as you hope they would over a short enough period of time. So with that, I will shift it back to Julie for any questions. My email is on the screen, by the way. So if anyone would like to kind of hunt me down for anything, I'm always happy to chat and help in any way I can.
Okay, thanks, Andy. I will just point out that we are over time right now, so we're going to continue with Q&A. Anybody that needs to drop off obviously can, and those that want to stick around can for the Q&A. Right now, the only question that came in for Andy, just a clarification, Andy, the percent of originations and pay downs is a percent of total loan balances. Is that correct?
Yes, that is correct. And if they're monthly numbers, it's just the way the math worked out to make more sense. But yes.
Okay. Okay, so let me see. Getting lots of thank yous for your presentations. I don't see any more questions right now in the queue. Oh, can you define, we've just had another one come in. Can you define wholesale funding?
Sure. So wholesale funding, I loosely define it as anything outside of your member base, right? So you have your retail deposits. Your retail funding is whatever shares come in the door from your direct members. Wholesale would be anything where you have the control. You're not waiting on the member to hopefully come in and wire a bunch of money. You can go out and you can borrow when you feel like it. You can raise non-member deposits when you feel like it. You can sell loan participations when you feel like it. So when it's liquidity that you have control over, that's what I define as wholesale funds or wholesale liquidity.
Okay. All right, that wraps up the questions that I see. So I would like to thank our speakers, Caroline and Andy, and everyone who attended. This presentation was recorded. You'll have access to the slides as well as the recording when it's available. And if Lucinda, I'll turn it over to you if there's anything else you have to say.
No, thanks everyone. Excellent presentation to both Andy and Carolyn. I think it was extremely useful information. Members are looking forward to getting their hands on your slides. So as Julie mentioned, we will get that up on the archive within a few days. We'll email that to everyone. And I really appreciate the time that you put into this. Excellent information for our members so that they can go out and support their members as the economy is still kind of an interesting thing to try and keep track of going into 2022. So good information for planning. Thanks, everybody. We will see you again online next time, either in a chat or a virtual roundtable. And everyone stay safe and have a great weekend. Bye now.
Bye. Thank you.